The US government seems to be heading for a shutdown that could leave the Fed flying blind. President Trump is set to meet Democrat and Republican lawmakers in Congress later today, but hopes are not high that they reach a compromise deal to fund the US government. That funding runs out at midnight on Tuesday. Without it, thousands of federal workers would be furloughed, and crucially for markets, the release of statistics like the jobs report would be delayed. Tim Graf is head of macro strategy for EMEA at State Street. Tim, historically, the market has not been much bothered by short shutdowns, but could this be different?
No, I don't think so. I think the lack of data, as you mentioned, would just create a bit of a vacuum in markets. But markets are right now very much in low volatility mode. There's not a lot that has shaken them. This was a fairly pivotal number. So if anything, it kind of takes out a volatility event. I don't necessarily think that's a good thing for markets, but I just think it's more of a benign, or it's kind of ambiguous as to what effect it might have.
But what does it mean for Federal Reserve policymakers, who are of course very data dependent, if this key jobs report doesn't come out on schedule this week?
Well, I think you have to wonder if the shutdown would extend very much longer beyond this. As you mentioned, shutdowns tend not to be a big deal. They tend to be resolved relatively quickly. The next Fed meeting is not for another 3 or 4 weeks. So there's still plenty of time for this to get resolved, plenty of time to see those jobs numbers. And also there's loads of other alternative data sources that are out there that kind of can give the Fed a picture, maybe not as robust a collection of data as the BLS produce and the statistical agencies produce, but nevertheless, there are indicators out there, and the situation will likely be resolved by the time it actually matters.
In FX markets, Tim, we've seen a recovery lately in the US dollar, especially against the pound and the yen. How do you explain that?
I think there are just some oversold conditions, and particularly consensus positioning against the dollar, coupled with some of the US data, which have actually not been that bad. If you're looking at the nowcasts for Q3 GDP data that are produced by the Atlanta Fed as they were updated last week, you're actually looking ahead at a period of what might be pretty robust growth for the U.S. consumer, and that's with the Fed easing policy in spite of that fact. There's a lot now priced into rate markets for what the Fed might do on the easing front. There's a lot of positioning short in the dollar. So I suspect it's a little bit of an unwind of that has been brought on by some of the better data that we've seen.
Do you think then the markets oversold the dollar and perhaps over-egged worries about the US economy, especially the labour market?
A little bit, to a degree, yeah. I think the rate market has probably priced enough for what the Fed will actually be able to do. Inflation in the US is still relatively sticky. The labor market is likely to remain tighter than it would have otherwise been because of labor supply issues. And so any Fed easing cycle at this stage is probably a very gradual one that gets you back towards neutral rates around 3% over the next, say, 18 months. So yeah, I think there probably was a bit of short-term, too much bad news priced into the dollar at that point.
We have a series of central bank speakers to look out for this week, both from the Fed and ECB policymakers. What are you listening out for?
For the ECB especially, I'm curious to see just whether they will confirm that the easing cycle is over. I suspect it is. We have real-time inflation indicators for Europe that show that the disinflation process, at least on the goods side, is basically done. It's probably close to done on the service sector side as well. And you're getting inflation releases from Europe that kind of suggest the same thing. Inflation rates are seen as rising in a lot of the Eurozone countries and starting to stabilize around or just even above target. So some confirmation from ECB officials that that is indeed the case will be what I'm looking out for there.
That was Tim Graf of State Street. Don't forget, you can watch more videos on Reuters.com.